Hi, Nero Thembi Pillay here from Investment Rise, and welcome to 2017. As I record this video, it's the first week of the new year. And what I want to do is in this video, outline first of all, what happened as a result of my predictions at the start of 2016. Was I right or was I wrong? And what do I expect to happen in the property market for 2017? Well, at the start of 2016, I made a few predictions. Number one, primarily, I said the Sydney property market would not crash. Boy, did I cop a lot of flack for that one. People think, oh, prices are so high, surely they've got to crash, it's got to fall. Well, we're now at the start of 2017. The Sydney market hasn't crashed. And I will put it to you again that Sydney market is not going to crash this year either, if any year in the future. So I don't believe there's a crash coming at all in the Sydney market. But what I also said at the start of 2016 is that 2016 was not the year to be entering the Sydney market as a property investor. And that still holds true today. Now that might seem a little contradictory when I'm saying this. The Sydney market won't crash. Well, then why wouldn't you invest in Sydney? Well, remember the key outcome, the ultimate goal for every property investor should be capital growth. Now, the Sydney market has had some phenomenal growth, but it's really run out of puff, run out of steam, especially in the last quarter of 2016. Why didn't it run out of steam even faster? I didn't expect it to have even the little bit of growth that it did have in 2016, so I got that bit wrong. But why? It wasn't because there were some economic fundamentals. It wasn't because of anything except for one reason. The Reserve Bank gave us two surprise rate cuts in 2016. And if you look at the reasons why they gave us the rate cuts, the fundamental reason, once you get through all the fluff, the fundamental reason was that they were concerned, and they still are concerned, about the oncoming glut of apartments in Sydney, Melbourne, Brisbane, and Perth. And so by giving the rate cut, they were hoping to reduce the impact of the coming oversupply and the consequences that will come from that. But here's the problem. The interest rate cuts, the impact of them has now been absorbed. But the onset of apartments, we haven't hit the peak yet. There's still so much more coming online. If you're in Sydney, Melbourne, and Brisbane, you know how many apartment blocks are being constructed around you, and Perth as well. And these have not yet been completed. Once we get to completion of most of these apartments, which is expected in 2017, that's when these problems are going to start to occur, with the market starting to really run out of steam. So then, will the RBA look to reduce interest rates? Unfortunately, I think they've played that card now. Why? Well, if you've seen one of my earlier videos, you'll know that, well, you already know that the president-elect of the United States is now Donald Trump. And whatever you say, whether you like him or don't, that's irrelevant. What you do know is that he's going to spend money. He has a very expansion-based fiscal policy, and that's going to cause interest rates to rise. In fact, the US increased their rates at the end of 2016. Now, the RBA hasn't moved yet, but the banks have. A lot of the banks have started increasing their variable rates, and definitely the fixed rates are on the way up. So what's that going to mean? Well, it's going to, I believe, be the final needle in the balloon that pops the growth rates of the Sydney, and even maybe to a lesser extent, the Melbourne markets as well. Those markets, they're not going to crash though, because we've still got a massive onset of immigration, but the prices will fall slightly. In fact, Harry Triguboff, the richest man now in the country, I think he owns more apartments than anybody else, around something like 70,000, depending on what report you read. He builds these apartments. And he says that he's expecting the apartment market to fall, but by 5%. So if you're an existing investor, an existing homeowner, there's no reason to panic, no reason to sell and fire sell quickly and to get out. But it's not the time to be entering the market. The rising interest rates will finally put, I believe, a halt to the growth rates in Sydney and Melbourne. We may get a bit with inflation, but nothing else. But investors will now start to look at higher yielding investment areas. And really, there's only one market in the country that I believe has a sufficient rental yield, at least key areas within that market rather, have a sufficient rental yield to be able to cash flow our investments. See, the rental yield in Sydney, for example, is around about 2.8%. So properties today in Sydney, they're generally cash flow negative. And then if we have rising interest rates on top of that, it's going to make the cash flow position even worse. We've also had some massive growth. And if you look at any 10-year cycle in Sydney, you'll know that we get 80, 90, 99% of our growth in a 3 to 4 year span. We've just had that. So I don't see a great deal of growth in the Sydney market. I can see interest rates rising. I can see cash flow shortages. For people who've owned property for a while, you've had some equity growth, it's fine to hold on. But for people entering the market, it's not the time. I do believe, however, that the only place right now to be investing for people who have $60,000, $70,000 in the bank or in equity is in certain key markets of Southeast Queensland. In fact, I've been saying this for a while, and one of the areas that some of my clients have been investing in now since 2013, in the last 5 years, it's had over 120% capital growth. Yeah, price is still only $500,000, mind you, for a house in that area. I'm not saying that's the place where you invest, but it shows that there are going to be there are some great areas for future capital growth coming forwards, but you just need to really do your research, work with someone who's got some experience to be able to guide you into where these areas are, make sure the rental vacancy is at a low enough rate so your property gets rented very, very quickly and easily. Great prospects for good capital growth with infrastructure and population growth. And if you do your investment from more of a strategic perspective, as opposed to a speculative perspective, which is what a lot of people in Sydney and Melbourne have done, is just buy something, hope and pray it goes up in value. I think those times are definitely gone, but there are still some great opportunities. I'm certainly looking forward to 2017. I think it's going to be the year of the strategic investor, the person who looks through all the information, gets the help, and I think the years of the speculator, they're behind us for the next little while. I hope that helps. That's what I expect in 2017. Some good news for investors with a strategic bias. Sydney, Melbourne markets, though, are places I'm generally going to be staying away from. Let me know what you think in the comments below. Speak to you soon.